More and more, you've been asking me how it is that you can finance a manufactured home. Today, we're going to be talking to Paul Barranco, a mortgage lender that lends money out for manufactured homes, answering all your burning questions. So let's go ahead and get started. If you've been doing your research, you've probably read that some mortgages are only for about 20 years when it comes to manufactured homes, but you can finance them for over 30 years. Paul explains this now.
My name is Paul Barranco. I'm with First Phase Mortgage, and we handle mortgage financing for mobile homes that are already in place.
So some manufactured home companies have been saying that you can only finance a manufactured home for 20 years. Is that true?
No, it's not. You can do a 30-year fixed, no prepayment penalty, no balloon, Fannie Mae or FHA home, or a VA loan on a mobile home.
Can you do a rural development loan on a manufactured home?
They came out with new guidelines on rural development about 2 years ago where they're doing it, but they have a really, really hard criteria, and lenders don't like to fool with it because it's hard to get them approved. But they can be approved, but they must be brand new homes.
What is the age requirement when it comes to a manufactured home? Is there a cutoff date when a manufactured home is actually too old to get a loan on?
It's June 15th, 1976. It has to be after that date of manufacture to qualify.
And that's because everything with HUD was approved after 1976. Anything prior to 1976 is considered a trailer, right?
That's correct. It wasn't labeled. It wasn't documented. There's a website called ibts.org, and that's where you can go in and verify on a mobile home what their tags are, their registration, and where it was initially moved and set up at.
Where can somebody find the tags on their manufactured home if they're unsure?
There's going to be two sets you got to find. One is under the kitchen sink. When you open up the cabinet door, there's a big label. That's the other is on the chassis or the frame. When they set up the manufactured home, they remove the wheels off of it. That's what makes it stationary. And on there, there should be the tags glued onto the frame, and that's where they pull those numbers from.
Not all home loans are created equal. And when it comes to size, does size really matter for the type of loan you'd be qualified for?
A single wide, you can do it if you're doing an FHA loan. If you're not doing an FHA loan, well, double wide, triple wide, you can do those on Fannie Mae or on FHA. Okay, but on a single wide, it's just FHA, and that single wide has to have been after 1976.
Is there a big difference between Fannie Mae, FHA? Is there going to be a big difference in like interest rates or requirements for the person to get approved for those specific loans?
Let me tell you the pluses and minuses. A lot of factors are looked at: debt to income, credit score, down payment. On a government loan, you always have an upfront fee you're paying. Like on FHA, it's 1.75%. And you're always going to pay a PMI of 0.85%. That's on there for the life of the loan. But the interest rate on an FHA loan is a lot lower than a conventional loan. If you have 760 credit scores, the FHA rate is going to be lower. Now, FHA's not as critical on credit scores as where your interest rate is. On a conventional loan, you can run anywhere from almost a 1.5% to 2% range, depending on where your credit score is. So a lot of the people with a 680 or lower credit score, a lot of times FHA is definitely your best deal. If it's above a 680, that's when you kind of start comparing both.
So how much a down payment would you need for a manufactured home?
On FHA, it's 3.5%.
Okay.
Conventional, it's 5%.
When someone's getting a manufactured home, is there any fees associated with it prior to actually getting the loan beforehand? Is there an application fee or anything like that?
No, and if anybody's doing a mortgage and somebody charges an application fee up front, then you can't do that. That's against compliance. People will charge junk fees, application and processing fees at the closing. We don't do any of that. The only thing you normally is going to pay is an underwriting fee. Up front, the only upfront fees on a mortgage that you're allowed to collect for is a credit report fee, and it has to be exactly for what the credit bureau charged you, and the appraisal fee, and you pay that fee direct to the appraiser. Yeah.
Now, if someone wanted to use their 401k or IRA for a down payment, could they do that in order to get a loan?
Yes. And the good thing, I'm glad you brought that up, because you don't actually have to, when I say take the money out, pay the big penalty to do that with. Most 401ks or IRAs have an emergency clause in there. And one of the emergencies is building a home. So with that, you can actually borrow the money against your 401k. The great thing is you're paying yourself back when you pay that money back on the 401k loan. And we do not have to count that in the debt to income ratio because you are paying yourself back. So yes, you can borrow or pull out of an IRA or a 401k, or you can get gifts from a family member.
How much of a gift can you get from a family member?
You can get enough to cover the whole down payment or closing costs too, and prepaid. You just have to document it. You got to document with 1 month bank statement that they had the available funds to give to you. And then you got to document the transfer.
Well, that's good to know. I didn't even know that.
Gift letter. Yeah.
And what the gift letter means is that you don't have to, the person that's getting the money is not doesn't have to return that money to the person that gave it to them, correct?
That's absolutely right. It states the relationship, and it states that the money doesn't have to be paid back, that it is a gift, and that they're gifting that money. Because when people put a down payment down or have to pay closing costs or prepaids, we have to source and season that money. We have to get 2 months bank statements, or we have to prove where it came from. That's why that gift letter and that tracking is so important.
Really important. You can't pull money out from underneath your bed.
That's right. That's right.
It's happened.
What they call that, the old mattress money.
Yeah, the mattress money. Can't do that. When you're shopping for interest rates, you're going to notice there is a big difference between regular stick-built homes, modular homes, and manufactured homes. So what is the difference between manufactured homes and regular stick-built homes? How much more are you going to pay because you're buying a manufactured home?
A regular stick-built home is a home you buy that we see that's either on pier or beams or on slab.
Mm-hmm.
A modular home is a home that's built at a factory, walls, ceiling, floors. They bring it over to the lot you want to put it on. They put all the plumbing and electrical, and then they put it together almost like a puzzle. That's a modular home. A modular and a stick-built home, as far as financing are concerned, are done exactly the same way. So modular and stick-built, same thing. Manufactured is different. I mean, it's brought over there on wheels. They have to set it up and set the base up. It's normally a vector system they'll set it up on and make sure that's right. We have to get an engineer out there to go make sure structurally it's sound when we're doing the loan. So there's a lot more moving pieces in a manufactured home. So
what is the debt to income ratio for these particular loans?
Let me explain something. We have a thing called DU, direct underwriter. Mm-hmm. Which is Fannie and Freddie, VA, as well as FHA. We run it through that automatic underwriting system. Okay, now the actual guideline states that if you get an approved eligible through that system, you're okay. You can do the loan. It doesn't give you an actual debt to income ratio per se. Fannie and Freddie, most of the time, it needs to be between 41 and 43. And what I mean by that is the cost of, the monthly note for your purchase of your home plus the monthly note of all your debts can't exceed 41 or 43% of your income. Okay. You can get it approved higher than that, but it just depends on credit score and how many months of reserves you have. FHA is a lot easier to get approved. I've gotten them approved up to 55% debt to income, even though the guideline says 41. Okay. But as long as I've got that approved eligible, you're okay. And that's not guaranteeing you're going to get an approved eligible. It looks at all the factors. It looks at how long you've been on your job. That's a compensating factor. It looks at whether there's some overtime or second job income we can't count. That's a compensating factor. It's looking at your debt to income ratio. It's looking at your credit scores. Is it a 760 or is it a 580? Where's it at? So all those factors are a factor, but the normal guideline is going to tell you 41% on the total income. Looking at just your house compared to your income, you don't want that to exceed 29%. The skirting on manufactured homes has become a sticking point for some lenders. Paul's going to explain to us what it is that they need to know about the skirting that goes around your manufactured home. You run into a lot of small issues sometimes doing the home. An appraiser goes out there, and it's all on how the appraiser notates information on the appraisal. Mm-hmm. So it puts that the skirting's on there, but it's not attached. Then you got to get somebody to go out there and attach it and get the appraiser to come out there. And it's got to meet the FHA guidelines for mobile home and the Fannie Mae guidelines for mobile home. All right, this one's really important. Are you going to be able to refinance this manufactured home later on down the line if you need a little extra money or want to drop your interest rate? You can do, if you're just trying to lower the interest rate, it falls under the same guidelines, Fannie or Freddie or FHA, and the same guidelines as all of them. You can go up to 80% on a cash out refinance. If you're doing a rate and term, you can go up to, I think it's 97%. That's with the, where you got closing costs and prepaids included in.
Right. And we're specifically talking about refinances where the manufactured home is attached to the land,
That's correct.
Not for properties that are in a manufactured home park. So, you can't refinance those loans. A lot of times those are called chattel loans and they're not the same thing.
It has to be your primary residence. Okay. And you have to own the land and the mobile home. It has to be considered at the assessor's office as a parcel, as a residence. Immovable is what the terminology is. And it has to be determined that for us to be able to do that loan.
Buying and financing a manufactured homes is probably one of the biggest decisions you'll ever make in your life. I want to thank Paul for taking the time to answering all the questions about mortgages. If you have any questions for me or Paul about manufactured homes, please reach out to us in the comments section. If you would like some more information about manufactured homes and you want to watch some more videos, you can click this video right here. My name is Kristina Smallhorn, your real estate whisperer, and I tell you all this because you matter.